So the path of least resistance is to just be like, well, I'm the banker now. I can skip a payment. I can pay myself less. I can pay, 2.9% like the commercial says. But in reality, you need to understand that you're stealing from yourself, your posterity, and anybody that could benefit from what you were actually trying to do. So I think when you're dealing with yourself as a banker, I joke about this, but talk to yourself, put a hat on, right? Like, I'm the banker now and I'm not me anymore. It is really a full mindset shift.
Welcome to the Bankless by Design podcast, where we rethink money, ditch the system, and rediscover what it means to truly thrive well. I'm Tricia Miller, mom of 7, financial coach, and founder of ThriveWell. Around here, we believe wealth is more than numbers. It's about freedom, stewardship, and building a legacy that lasts. If you're ready to challenge the norm and take back control of your financial life, you're in the right place. Welcome to the Bankless by Design podcast. I'm your host, Tricia Miller, and I'm here again with my son, Jonathan. Today, we're picking up with part 2 of our conversation on pages 23 and 24 of Nelson Nash's Becoming Your Own Banker. In the last episode, we talked about our human life value, the importance of properly protecting the people we love, and one of Nelson's biggest mindset shifts, that our need for finance is greater than our need for life insurance protection. And that is a big statement, because Nelson was not saying that protection does not matter. He was saying that when we solve for the financing function through properly designed dividend-paying whole life insurance, the protection comes along with it, and often in far greater measure than most people would ever have purchased if they were only thinking about the death benefit. But now Nelson takes us one step deeper, because if we're going to become our own bankers, we have to learn how to behave like bankers, honest bankers. That means we have to understand policy loans, the importance of repayment and interest, and we have to understand why not paying ourselves back can undermine the very system that we are trying to build. So today, we're going to talk about what it means to pay yourself back with interest, why Nelson uses such strong language around stealing from your own system, and how this whole idea grows beyond just one policy into a private banking system that can serve future generations. So let's jump right back into the conversation.
Here comes the important part again, so pay close attention. The insurance agent now needs to make him vividly aware that he must pay the loan back at an interest rate that is at least equivalent to the going interest rate of an automobile finance company, not what the policy calls for. In this case, it should be at least $260 per month. If the policyholder does this, then he will effectively make what the finance company would otherwise make and do it all on a tax-free basis. If the agent is really good and understands the principles of banking, he will encourage the policyholder to pay $275 per month, because the extra dollars will go to his policy to increase the capital that can be lent to other parties. If the policyholder objects that, it's my own money and I am not going to pay any interest at all, or maybe going to pay 2.9% as seen in television commercials, then the agent must remind him of the grocery store at the beginning of this book and explain to him one more time. If he still doesn't understand, then the agent needs to have him revisit the story of the failure of the First National Bank in Midland, Texas. If he still doesn't understand, the agent needs to resign from working with him because he is not teachable and or is a thief. Neither of these characters is a desirable business associate, excuse me.
Nelson. It's pretty funny sometimes. In fact, I can hear his voice so many times when you read this. Okay, here comes the important part. He's got to pay the loan back at an interest rate that is equivalent. So if he's going to take the place of the car dealership, the way the car dealership made money was to charge interest. So you're going to take the place of that institution that you would have paid with interest anyways. You were already going to pay it with interest. So just pay yourself back that way. But here's an interesting little piece here that we don't want to miss. The finance company would have made this money otherwise, but guess what? They would have had to pay tax on it. You're getting to earn that on a tax-free basis. And your money is going back on a policy loan and it's growing inside of a policy and it's receiving dividends. And therefore, the growth of all of that money is on a tax-free basis. What other place can we make money tax-free today?
Not very many.
Not very many. That's right. So that's even an advantage to going into the banking business for yourself with a dividend paying life insurance contract, because you're getting to actually earn some dollars that are not taxed. But then he goes on to say that a good life insurance agent that understands the principles of banking would encourage him to pay even more. This is hearkening back to the grocery store example, right? He said you should walk out the front door and pay full retail price for the can of peas. But then he says, but better yet, instead of 60 cents, which is the price a consumer would pay, you should pay 63 cents. Well, why?
Mhm.
Because now you're growing your system even greater. And this is so that you can increase the capital that now can be lent to other parties. So he's touching on it here about what we're going to do with these policies going forward after we've solved our need for our own finances, right?
Mm-hmm.
We can now become the banker with other people and lend to them and have them pay us back with interest, which is even more fun.
Then you're really becoming your own banker.
Then you're really becoming the banker, and that can stay in the family as a private banking system. Or businesses can do this too. Churches can do this. It's a mindset shift because we have to think about being our own banker. Anything that brings up in your mind that you want to discuss?
Yeah, I think in general, we've talked about this so many times about, the willingness to pay yourself or perhaps your mom, for example, with you and I, because I've taken policy loans from you, right? Being willing to pay even more than I probably would have an interest with, the finance company. But I do think that that's just like so integral to all of this, is that there's the temptation. And I know I don't know if we'll go to page 26, but I know how he ends it, and he uses a very strong word in how he describes the human urge. It's to steal. It's this mental battle where we're like, well, I could have it for free, for cheaper. I don't even know if it's a human trait. It might be a consumerism trait.
It's just the path of least resistance.
Yeah,
it's the easiest thing to do.
Thank you.
Yeah.
Yes. So the path of least resistance is to just be like, well, I'm the banker now. I can skip a payment. I can pay myself less. I can pay, 2.9% like the commercial says. But in reality, you need to understand that you're stealing from yourself, your posterity, and anybody that could benefit from what you were actually trying to do. So I think that's a really key part for all of us to understand when you're dealing with yourself as a banker. I joke about this, but talk to yourself, put a hat on, right? Like, I'm the banker now and I'm not me anymore. It is really a full mindset shift. And I just think that that's just the most important part to focus on there.
Two things that you bring to mind. So one of the faulty things, he says, I'm only going to pay 2.9%. It needs to be clearly understood that when you borrow against your cash values, there is an interest rate that the life insurance company is charging you, first of all.
Yes.
So your 2.9% payback may not even be sufficient to cover what the life insurance company is charging you, because you're not actually borrowing your own dollars. So I just want to make that clear. You're borrowing the life insurance company's money to purchase whatever the item is that you're going to purchase. So when you pay back, you are paying back with interest to the life insurance company. But the reason you're doing that is because your dollars are allowed to continue to grow. It keeps you from interrupting that compounding. And you want to pay an interest to that life insurance company because now you are a mutual owner in that company. So a company that you co-own, do you not want that company to be profitable? Because when they're profitable, you're also going to receive a dividend. It is mutually a win-win situation. We've got to quit thinking that in this scenario, which again, this is a mindset shift, that interest is somehow bad. But then you're going to want to pay additional interest so that it is capitalizing your system, going beyond what the life insurance company is charging. So let's just say we're talking about a car where you might only pay 2.9% at the dealership. My temptation is to say, well, I'm going to just do what the dealership did and I'm going to pay 2.9%. And we could get into how the policy loans interest is figured differently and all of that, but without going too complicated. So you decide you're going to pay 2.9%, but the life insurance company is charging you 6%. Well, you may or may not be paying it back sufficiently to pay back what the life insurance company is charging you. And then you certainly aren't adding anything to your own system. And every time you add additional dollars into your own system, let's not forget we get to use them again.
Let me ask you something. Like you said, we are not actually borrowing our own money. We are collateralizing our value in our loan as like putting up it as collateral and then taking a loan from the life insurance company. When we're talking about paying more than what the life insurance company requires, are you still paying that amount directly onto the policy loan, or are you paying what is required to the policy loan and then putting the rest onto your actual premium? Does that make sense?
Well, there's different ways that you can do it. Yes, you certainly could if you have premium that can be paid. But let's say your premium is fully paid for the year. Well, then I would be creating an amortization schedule that is above and beyond what I would have paid to the car dealership, but is also sufficient to cover the life insurance company's loan. So let's just say if the life insurance company is charging me 6, I'm going to charge myself 10. So I'm going to create that amortization schedule, 10%. Now, I'm the banker. I set the terms. The life insurance company, despite the fact that I've borrowed money from them, does not care how much I pay back, when I pay it back, over how much time, because it's a lien against my death benefit.
They take it from your death.
They're going to get it one day, one way or the other. So that's why they don't care. So I'm going to determine all of my terms, and I'm going to regularly hit that amortization schedule. So as I make those payments back on my amortization schedule, if there is no premium to be paid, then I'm just going to put it straight to the loan. And I'm going to keep paying that policy loan back. But let's say I get to a place where the policy loan is paid back with the life insurance company, but because I was charging extra, my amortization schedule is not yet complete. Do I get to just say, goody, it's all paid up? Well, Nelson is saying here is no, stick with your amortization schedule. Keep going. But if I don't have any place to put it right now, I might have to set up a side checking account and hold that until I have more premium that I can pay. So maybe it needs to sit there and accumulate until my premium comes due. However, if I find myself doing that on the regular, then that is a key indicator to me that it might be time to open up another policy. Because as we will see, this is going to create a system of policies. Does that clear that up a little bit?
Yep, 100%. I think it was good to just hear an actual practical example of what that would look like.
Yeah, absolutely. Because I know that can be a little bit confusing for people who haven't done this before. Very typical question. So thank you for asking it. One other point I wanted to make about the fact that Nelson says that if someone does not want to pay interest back to themselves, and you've told them about the First National Bank in Midland, Texas, and you've shared with them about the grocery store example again, and they still refuse, he's not teachable or he's a thief. It just cracks me up. Let's talk about this thing about being a thief for a second. If we set up a family banking system in our family and we don't want to pay interest back to the family banking system that you are ultimately going to benefit from, or even your own personal, but you're willing to pay it to the third party bank because you're actually valuing their capital more than your own, he says that's being a thief and that we should not do business with those sorts of people. Let me just say it this way. If you are not willing to pay back your system with interest, you're actually stealing from your own system. It's a little bit like being a cheater in solitaire. Like, what's the point of even playing the game?
I do think there's a needed mindset shift, what you were kind of hinting at a little bit of like, if you're willing to do that with a third party that you have zero relationship with, zero interest in, zero financial, like actual equitable interest in, why wouldn't you be willing to do it with your own system that you have the most amount of interest and concern in, right?
And so I think it actually drives that point that you're either unteachable and you can't figure it out, or you do understand it, then you're a thief. I don't know. I think he's pretty spot on. As funny as that sounds. Okay, so let's go ahead and continue on.
All right, finishing up page 24. You have now had an explanation of all the essential principles of banking through the use of dividend-paying life insurance. But to understand the infinite qualities of the infinite banking concept, it requires a deeper look. In the above example of the car financing, the capitalization needs to be somewhat greater than just 4 years. Many college business professors estimate that corporations expect it to take at least 7 years to get back a profit on a new investment. This is an understatement in certain undertakings. So why not capitalize each policy purchase for at least 7 years to the point where dividends will pay all the remaining premiums on the policy? This will be explained in detail later on in the book. Would you have much of a grocery business if you were the only customer? You must build it to the point where you accommodate the needs of others in order to prosper. The same principle applies to banking. Furthermore, I am not describing one life insurance policy. This is to be a system of policies. Have you not noticed that when a grocery store becomes successful in one location, then it tends to establish another store in another location? Have you not noticed that banks have branch offices? There must be a reason for their behavior. Then why not expand your own potential by buying all the life insurance on yourself that the companies will issue, and then on all the persons in which you have an insurable interest? At present, does not all your income go through the books of some banking institution? Don't the banks lend out the deposits of customers? All they do is capitalize the bank, capital stock, to make it a safe place for customers to deposit their money and then lend out the money left on deposit. If they don't lend money, they will go out of business. It will take the average person at least 20 to 25 years to build a banking system through life insurance to accommodate all his own needs for finance, his autos, his house, etc. But once such a system is established, it can be passed on to future generations as long as they can be taught how the system works and suppress their basic instincts to go out the back door of the grocery store, or in a word that is more descriptive, steal.
Okay, there is a lot in this section. First, he's basically saying we're wrapping this up. You've got enough information here now to recognize that you can use dividend paying whole life to create a banking system. He says in the above example of car financing, capitalization needs to take somewhat greater than just 4 years. But then he also mentions, why not capitalize each policy purchase for at least 7 years to the point where dividends will pay all the remaining premiums on the policy? I had a conversation with a friend recently. Actually, I'm going to give her credit. It's Becca Wilhite. And she talked about the importance of understanding this book in its context. In other words, a little bit like reading the Bible. If we pick out one little verse and take it and run with it, we could be completely out of context and create a whole new theology that isn't even true. The same thing can happen here. And I think it actually has happened here. So when Nelson talks about at least 4 years or at least 7 years, he's not saying that that is the ideal. He's just saying at least 7 years. He's basing it on this whole idea of what corporations do. And he's also living in a different time frame. So there are practitioners out there who will design a policy for only 4 to 7 years. And then you can't put any more money in them. They will either do reduced paid up, or they'll have the dividend pay that, and they'll say, look, that's what Nelson said to do. Well, think about that for a minute. Do you remember the policy we just talked about that Nelson had from 1959 that was making 10 times the amount of premium in the dividend because it was 52 years old? That doesn't happen in 7 years. And we're basically stunting the growth of a policy. So be careful here. Don't take this little section and think, well, that's all I got to do. Now I'm short-term thinking again. The idea is capitalize, capitalize, capitalize as much as you possibly can. In fact, because I think this is just important because this has been a practice of many people who claim to be doing infinite banking. So I'm setting this out here as a little bit of a warning to the consumer to consider. In the back of the book, under the glossary of terms on page 87, under the capitalization period, Nelson literally says, you still need to continue the capitalization phase for as much as 10 years or more. The longer the period, the more strength of your system. And on page 63, there's an addendum where he says, I am afraid that these folks have missed the main point of creating your own banking system. A system consists of many life insurance policies, which we're going to talk about in a second, and the number of years that each policy is capitalized must increase when interest rates go down if you are going to expect similar results as those depicted. Well, we have been in a very low interest rate environment for many years. It is starting to pick back up, but it's still relatively low. So there's many reasons why Nelson might have said at least 7 years, or even in equipment financing later on in the book, he'll show 4 years. And he'll also say, if I was designing a policy, I would never design it this way. He's just trying to make a point sometimes. But if this idea is taken out of context, it can put them down a trail that is not necessarily the best or the most optimized for their future. So I wanted to explain that and also just give a shout out to Becca for the idea that we need to take the entire book in its context to really get what Nelson is saying here, and then go on to realize that he's saying, in fact, we want to capitalize our system as much as possible. And then he says it's an entire system of policies so that we can actually become a lender to others. And so then he likens it to this idea that would we have much of a grocery business if we were the only customer?
No, not really.
So it is far more challenging for me to borrow against my policies and pay myself back with interest than it is to lend you money for a car and get to have you paying that back with interest, just like it will be for you when you build your own policy and you get to do that as well one day, right? It's not even just what's difficult. It's also how many times we're getting to earn interest on those dollars inside of that policy.
How many times can you flip the can of peas?
How many times can you flip the can of peas? Right, exactly. So if I'm doing it, it's only happening once. If you're doing it with me, now it's happening twice. If we're adding other people to the system, it's happening 3, 4, 10, 20 times. And this is what Nelson eventually did. He had as many as 42 life insurance policies by the end of his life. He had multiple policies on himself, his wife, his children, and his grandchildren. And they used that system as a family such that there came a day, for many years in fact, when none of them ever darkened the doors of the bank. They would borrow against those cash values to purchase a home and pay the mortgage payment back. How would you like to be that intermediary, getting that kind of interest coming back into your system? Well, eventually that can happen. That's not the first thing we do. This is why he often speaks of something a little bit less like a car, but it can happen with student loans or credit cards or you name it, small personal loans. All of these things can be taken over a little at a time. And then once we've got all of that conquered and our need for finance, although we still go buy more cars, don't we? We still have a need for finance, but then we can expand our system to accommodate the financing needs of others as well. So we want to build it to a point that we can actually do that in order to prosper. So I mentioned that he had 42 policies on all of his family members. Nelson also had life insurance policies on other people that he had an insurable interest in. So keep in mind, this can include key persons, partners in business. And I know at one point he said he had a policy on someone who was an acquaintance and he'd lost touch with him. But eventually the man passed away. And he said that made up for a lot of financial mistakes in his life because he got the windfall. So think creatively here. All right. Let's look at this one sentence here. He asked this question, at present, does not all your income go through the books of some banking institution? So he's going to get into this idea that he had the ability to take care of all of his financing needs. Did not happen overnight. He says it should take the average person 20 to 25 years. But does not all your income go through the books of someone else's banking institution anyway? So we're talking about 100% of our income equaling premium. That's down the road, but that's something, that's the goal. I know one practitioner that has what he calls the 100% club, and he has several clients who are at 100%. How fun is that? That would be a room I would love to sit in.
So I talked to you a little bit about this before we started recording. Obviously, there will always be a need for the common bank, whether it's cashing a check or what have you. But like kind of what is the end all be all goal, if that makes sense? Like what is the final goal? In the perfect world, when you have maximized 100% of your income into premium, what does that look like? Are you getting paid from your company? It goes to your bank account and you're immediately putting it all into premium? Or like, is there a way to put it directly? What does this actually look like?
The very first thing that comes to mind is Nelson would say it is a peaceful, stress-free way of life to not have to deal with the banks in your life anymore. So if you can imagine, just think when you go to buy your first home, the questionnaire, the application, all of the things that you have to drum up for the bank to get approved for that loan, it is painful. They will ask you a million questions. They'll want to see proof of your income. They'll want to see all of your debts and all of your payments. And then they might tell you that you don't qualify or you need to do this in order to qualify. So imagine all of that is gone and you don't have to ask for approval and you have access to capital at any moment. You just simply go and you tell the life insurance company, I want to take a loan and I want you to put it over here into my bank. So you're not asking permission. You're able to just do what you want and need to do without permission. And if you're capitalized, you have access to plenty of money to take advantage of opportunities that might come along that are exciting, right? So that's a great way of living. You also don't have to worry about the future. You've got thoughts about your children and your grandchildren. You know they're secure. But beyond that, your question about the banking, Nelson's idea was not that banks are never used at all. they're used strictly for the function of debit, your checking account. There's no way in our system today, at least, to avoid using a bank for the function of debit, just not for the function of financing, if that is helpful.
Absolutely.
So you're still going to need your checking account to do business today for transaction purposes, because the life insurance company is not a bank. We're just using them for the process of banking.
That makes sense.
Okay.
No, and that was really what I wanted to understand better, was what it actually looks like, because otherwise it sounds hypothetical, I guess.
Honestly, the really neat thing is that the think tank, Nelson's son-in-law, David Stearns, has often put up on the slides a picture of the whole family, all the different policies, which ones were bought first, how much premium was paid, and then how much death benefit arrived to the family, but just showing what this actually looks like. And the interesting piece was that the premiums on those life insurance policies, none of them were huge. I would say the biggest premium that Nelson paid into a policy was probably about $3,000 a year. These were little policies. He just had so many, and he held them for such a long time. I remember that being a bit astonishing to me. And then just seeing that he set his family up, and now his family, they have received that. And I will say, my understanding is that not every one of his children is on board. So, there's the reality of family systems sometimes. But those who are on board and those who have paid attention and have learned how to do it are using those funds to now fill up their own policies, which will continue down the generations. And as we get into that, I think you will find that it really starts to show you a beautiful picture of how this can just be perpetuated into the future when we get into an even distribution of age classes and ensuring grandchildren and so forth. But it really does require an education to go along with it, or all of our efforts can be lost. If the death benefit is just simply put into people's hands to be spent as cash, and it's gone. And that would be sad. That brings to my mind the Vanderbilts versus the Rockefellers. Both of them very, very wealthy. The Vanderbilts are now broke, but the Rockefellers continue to perpetuate wealth every single generation. And they do this because they have had a very strong education, and they use trusts where how it is passed on, new insurance policies are purchased, is part of the mandatory nature of the trust structure as well. So Nelson did not use trusts, but some people do in order to help protect that continuation of the generational wealth.
Sorry, I feel like I might have taken us in a couple tangents on that. My bad. I was just asking questions that were coming across my head.
No, it's okay. So the ultimate goal is to join the 100%er club. And you did mention that, like, what does that look like? Yeah, it looks like a lot of your income going into premium. And when you have a system of policies, the premium and the policy anniversary dates are not all the same. So that means that throughout the year, the more I grow my system and the more policies I have, the different policy anniversary dates I would have. So I would have an open bucket in October, and then another open bucket in January, and another open bucket in July, or, throughout the year. So I have places to put all of the income that's coming in.
Gotcha. Okay. Yeah, that makes sense.
Well, I think this actually wraps up this chapter. I don't even recall, but there has been several episodes just out of this one chapter. It was packed full. It's the end of part 1. There is a page here, basic understanding and review, that we might touch on in another episode before we head into part 2. But I'm so glad that you made it to wrap this one up with me. Is there any final thoughts that you might have?
Best time to plant a tree was 15 years ago. The best next time is today.
That's right. When you see this, get started, because time is going to pass anyways, and we might as well get started, even if it's small. Thank you for that. I appreciate you being here, Jonathan.
Thank you so much for having me.
You're so welcome. And to our listeners, thank you so much for joining us today on the Bankless by Design podcast. If this episode gave you something to think about, would you share it with someone that you care about? And if you have not already, be sure to subscribe so you can join us for the next episode as we continue walking through becoming your own banker together. Until next time, have a great week. Thank you so much for listening. Thanks for tuning in to the Bankless by Design podcast, where we're done with the system and we're doing money differently. Be sure to subscribe, share this episode with someone who needs it, and visit us at bankless.Design.com to learn how you can start living bankless by design.